everyone, welcome back to Corporate Decoder, the place where we decode the sometimes confusing world of corporate filings. Today we're diving into a report from the Federal Home Loan Bank of San Francisco, and trust me, it's not as boring as it sounds. We're talking about debt, obligations, and how this bank keeps the money flowing. It's a bit like peeking behind the curtain of the financial system, so buckle up. We'll find out what this bank has been committing to, what the risks are, and what it all means. Before we jump in, if you like getting clear explanations of complicated financial stuff, hit that subscribe button. Also, join our Discord community. The link is in the description below. This report is a Form 8K, a current report, and it's dated May 1, 2025. This means it's giving us an update on important events that the bank wants to share with the Securities and Exchange Commission, or SEC. It's like a snapshot of what's happening right now. The main point of this report is to talk about the bank creating what they call direct financial obligations. In simple terms, it means they are taking on debt. The Federal Home Loan Bank of San Francisco gets most of its money by selling debt securities, which are like bonds or notes in the financial markets. They call these debts consolidated obligations. Think of it as the bank borrowing money to fund its operations. These consolidated obligations are actually the joint responsibility of all 11 federal home loan banks. So if one bank can't pay, the others have to step in. The Federal Housing Finance Agency or Finance Agency oversees these banks and can even make one bank pay the debts of another if necessary. It's important to know that these consolidated obligations are only supported by the financial strength of the 11 federal home loan banks. The United States government doesn't guarantee them. So if the banks struggle, these debts could be at risk. The report includes something called Schedule A. This schedule lists all the bonds and discount notes that the federal home loan banks have committed to issuing, where the San Francisco Bank is the main borrower. It's like a list of all their new debts. However, it doesn't include very short-term debts like discount notes that mature in less than a year, unless they've taken over the responsibility for those debts from another federal home loan bank. The report mentions that while issuing these consolidated obligations is important to the bank, they aren't saying that any particular debt is critical. Also, Schedule A doesn't include any interest rate agreements or other financial tools they might use to manage their assets and debts. These agreements could be related to the debts they're reporting. Finally, you can't use Schedule A to track all the outstanding debts for which the bank is responsible because it leaves out those short-term notes and doesn't show if the money raised is used to pay off old debts. To see the total amount of debt, you'll have to look at their regular reports filed with the SEC. The amounts in Schedule A are the face value of the debts, which might be different from what's reported in their financial statements due to discounts or premiums. Now, let's get to the exciting part, the numbers. We are going to look at Schedule A and highlight some of the most important details. On May 1, 2025, they committed to issuing a bond with a Series S&P 5 that matures on June 2026 and has a coupon or interest rate of 4.3%. The amount they're borrowing is a whopping $1 billion. On that same day, they committed to issuing another bond with the Series number 3A13 number 3130B67H3 maturing on May 13, 2030 with a coupon of 5.01%. This one is for a much smaller amount, $15 million. Let's look at another one. On May 2, 2025, they committed to issuing a bond with QSRP 313-030B6BB1 maturing on May 7, 2027 and paying a coupon of 4%. This one is for $10 million. It's worth noting that these bonds have something called optional principal redemption, which means the bank can choose to pay them off early. The exact dates on which this is possible vary. Some of them have American-style optional principal redemption, which means they can pay them off continuously after the first optional redemption date. Some have Bermudan style, where they can pay them off only on specific recurring dates after the first optional redemption date. And some have European style, which means they can only pay them off on one specific date. These bonds generally pay interest at a fixed rate over the life of the bond. In other words, it's a fixed amount of interest. The report was signed on May 6, 2025 by Antonio D. Rustiti, Senior Vice President and Treasurer of the Federal Home Loan Bank of San Francisco. This signature means that he's responsible for the accuracy of the information in the report. So what does this all mean? Basically, the Federal Home Loan Bank of San Francisco is actively borrowing money to fund its operations. This is normal for this type of bank, as it provides funding for its member banks. Looking at the numbers, the $1 billion bond is a significant amount. While the others are relatively smaller, the interest rates on these bonds range from 4 to 5.01%, which reflects the market conditions at the time they were issued. One thing that stands out is the optional principal redemption feature on these bonds. This gives the bank flexibility to pay off the debt early if interest rates go down or if they have excess cash. A potential risk is that these consolidated obligations are not guaranteed by the US government. So if the Federal Home Loan Banks face financial difficulties, there could be a risk of default. Overall, this report provides a snapshot of the Federal Home Loan Bank of San Francisco's debt activity. It shows that the bank is actively raising funds in the capital markets and is managing its debt with some flexibility. However, it's important to keep in mind the risks associated with these obligations as they are not government backed. Alright, that's our breakdown of this SEC filing. What's your take on these numbers and what they signal for the bank's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.